I'm going to say something that might make you want to click away, and I need you to stay anyway. You don't need a bigger account. You need a different mind. Because right now, you are unconsciously designed to lose. Not because you're weak, not because the market is rigged against you, but because every instinct your brain developed over thousands of years of human evolution is the exact opposite of what consistent trading requires. Protecting yourself from danger, avoiding pain, seeking certainty, those are survival skills. In the market, they're self-destruction. The good news? Minds can be rebuilt, and it costs nothing but honesty. Stay with me, because what I'm about to share with you in the next several minutes has the potential to change not just how you trade, but how you see yourself. And that shift, that single interior shift, is worth more than any strategy, any indicator, any course, or any funded account you could ever obtain. Let's start with the truth nobody in this industry wants to say out loud. Most small account traders are not failing because their strategy is broken. They are not failing because the market is unfair. They are not failing because they need more capital, more data, more screen time, or a better broker. They are failing because they are attempting to operate in one of the most psychologically demanding environments on earth, a place of total uncertainty, instant feedback, and real financial consequence while carrying a mind that was never, ever built for it. And that's not an insult. That's just biology. When you sit down in front of your trading platform and you watch that price move, something ancient and deeply wired inside you begins to activate. The moment a trade goes against you, your brain does not experience a statistical outcome in a probabilistic series. It experiences a threat. Your nervous system, the same nervous system that kept your ancestors alive on the savannah, registers that red number as danger. It floods your body with cortisol. It narrows your thinking. It pushes you toward one of three responses: fight, flee, or freeze. And in trading, those three responses have very specific names. Fighting looks like revenge trading. Fleeing looks like cutting your winners too early and sitting on your hands when your setup appears. Freezing looks like watching a loss grow because you simply cannot bring yourself to close it. Sound familiar? Of course it does. Because you are human, and being human in the market without the right psychological foundation is a losing proposition regardless of how much money you have in your account. But here is what I want you to hear, and I want you to really let this land. The size of your account is not your problem. The size of your account is just the place where your actual problem is showing up most visibly. Your small account is not a reflection of your intelligence. It is not a verdict on your potential. It is not proof that you don't belong here. It is a mirror. And right now, that mirror is showing you something about the way you think. Specifically, the way you think under pressure, the way you respond to uncertainty, and the way you relate to being wrong. And here is the most important thing I can tell you today. What you see in that mirror can be changed deliberately, consciously, with the right understanding and the right practice. That is what this video is for. Before I get into the specific truths and the specific practices, I want to take you somewhere. I want to tell you about two traders, not because I'm trying to teach you a lesson, but because I want you to feel something. I want you to feel the difference between what trading looks like from the outside and what it actually is on the inside. Because when you understand the inside, when you really understand what's happening in the mind of a trader, everything changes. Imagine two traders. Let's call them David and Michael. They both have the same strategy. They both use the same broker. They both have access to the same charts, the same indicators, the same market. On any given morning, they both look at the same setup and they both decide to take the same trade. And then something extraordinary happens, or rather, something that most people would call extraordinary, but that I would call completely predictable. David grows his account slowly, steadily, almost boringly. Week after week, month after month, he adds a little. He has losing streaks. He has bad weeks. But the trend, over time, is unmistakably up. Michael destroys his account in 11 days. Same strategy, same market, same setups. 11 days. Now, if you asked most people to explain this, they would reach for the obvious explanations. Michael must have been undisciplined. Michael must have had bad luck. Michael must have used too much leverage. And maybe, on the surface, all of those things are true, but they don't explain the deeper reality. They are symptoms, not causes. The real difference between David and Michael lived in a single belief, one invisible, unspoken, almost unconscious assumption that each of them carried into the market every single day. David believed that a losing trade was information. Michael believed that a losing trade was a verdict. Read that again, because it is the entire game. When David had a losing trade, his nervous system processed it as data. This trade didn't work. My stop was hit. I move on to the next one. No drama. No self-recrimination. No desperate attempt to claw back what was lost. Just, this is part of the process. This is expected. This is fine. When Michael had a losing trade, his entire identity activated. Losing meant something was wrong with him. Losing meant he had made a mistake that needed to be corrected urgently, immediately, right now. Losing was not an acceptable outcome. It was a personal failure that demanded a response. And so Michael responded. He widened his stop on the next trade. He doubled his position size to recover faster. He stayed in trades that had clearly failed because closing them would make the loss real. He moved his stop loss. He added to losing positions. He chased entries he had already missed. And within 11 days, the account was gone. Same strategy, same market, two completely different inner worlds. Your account right now, today, is not being shaped primarily by your strategy. It is being shaped by what you believe a losing trade means about you. And until you change that belief, nothing else will matter. Not a new strategy, not a funded account, not better risk management software, not more hours studying the charts, nothing. Now, let me take you somewhere else. I want you to do something with me. I want you to imagine a version of yourself, a future version, maybe 2 or 3 years from now, who has already worked through all of this, who has already done the interior work, who has already built what I would call a consistent trading mind. This version of you wakes up in the morning and looks at the market without anxiety. They identify their setup. They enter the trade. They place their stop. They set their target, and then they wait. They don't refresh the chart every 30 seconds. They don't move the stop because the trade is going against them temporarily. They don't close the position early because they feel nervous. They follow the plan. And when the trade closes, whether for a profit or a loss, they feel the same thing. Not indifference, not coldness, just acceptance. This was one trade in a long series of trades. My edge plays out over hundreds of executions. This single outcome tells me nothing meaningful about my ability or my future. Now ask yourself, and I mean really ask yourself, sitting here right now, what does that future version of you believe that you don't yet believe? Because here is the thing that took me a long time to understand, and that I want to give you right now for free. So you don't have to spend years learning it the hard way. That future version of you is not smarter than you are. They don't have a better strategy. They don't have more money. They don't have some secret system that you haven't discovered yet. They just stopped needing the market to tell them they were okay. They stopped using the profit and loss statement as a measure of their worth as a human being. They stopped treating every winning trade as proof they were smart and every losing trade as proof they were stupid. They separated their identity from their outcomes. And in doing so, they freed their mind to do the one thing that trading actually requires: to execute a process consistently over a large sample of trades without emotional interference. That is what we are building today. Not a strategy, not a system, a mind. So let's get into the specific truths. And I want to tell you up front, some of these are going to feel paradoxical. Some of them are going to feel counterintuitive. Some of them might even feel wrong at first. That's okay. In fact, that discomfort is a signal that you're on the right track. Because trading is a paradoxical environment. The things that feel right in trading are very often wrong. And the things that feel wrong are very often right. So stay open. Let the ideas land before you decide what to do with them. The first truth is this: the market does not know you exist. I know that sounds cold. I know that might feel a little deflating. But I want you to sit with it for a moment, because it is actually the most liberating thing a trader can hear. The market has no memory of your last trade. It has no awareness of your account balance. It does not know that you need this trade to work to pay a bill. It does not know that you've had a bad week and really need a win. It does not know your name, your story, your fear, or your ambition. It is a completely impersonal, probabilistic mechanism, the aggregated expression of millions of market participants making decisions simultaneously, and the price that emerges from all of that activity carries no personal message for you. None. But here's what happens when traders, especially small account traders, don't understand this. They start to personalize the market. When the market goes against them, they feel targeted. They feel cheated. They feel like the universe is conspiring against them specifically. They say things like, "The market always does this to me," or "Every time I enter, it reverses." And those statements feel absolutely true from the inside. But they are not true. They are the result of a mind that is desperately trying to find patterns, trying to create a narrative, trying to locate control in an environment that is fundamentally, irreducibly uncertain. Personalization is a cognitive distortion, and it is incredibly expensive. Because when you believe the market is doing something to you, you respond emotionally. You take it personally. You try to fight back. And the market, completely indifferent to your feelings, keeps doing exactly what it was going to do anyway. The antidote to personalization is not detachment. It is not forcing yourself to not care. The antidote is a genuine, internalized understanding that outcomes in the market are the result of probability playing out over a series of events, not the result of some cosmic judgment on your worth as a person. Your last trade was not about you. Your next trade is not about you. The market is a mechanism, and your job is to operate within it as skillfully as you can, which means operating without the distortion of taking it personally. Here's the paradox of this first truth. The traders who accept that they cannot control outcomes, who genuinely, deeply accept it, consistently produce better outcomes than the traders who are constantly trying to control everything. Because acceptance clears the mind, and a clear mind executes better, thinks better, and adapts better than a mind clouded by the emotional noise of personalization. The second truth is this: consistency is a state of mind before it is a track record. This one is subtle, but it is enormously important. Most traders think of consistency as something that shows up in their results. Consistent profits, consistent win rate, consistent returns. And yes, eventually, that's what it looks like from the outside. But from the inside, in the experience of the trader, consistency is something entirely different. It is a way of relating to the market that remains stable, regardless of what just happened. Consistency means that you approach your next trade with the same mental energy, whether your last 3 trades were winners or your last 3 trades were losers. It means that you execute your stop every single time without deviation, regardless of how strongly you feel that this trade is the one that's about to turn around. It means that when you have a winning week, you don't increase your risk dramatically because you feel invincible. And when you have a losing week, you don't decrease your risk dramatically because you feel broken. Consistent behavior, applied over time, produces consistent results. That is a mathematical fact. But consistent behavior requires consistent beliefs. And consistent beliefs are not something you develop by reading about them. They are something you develop by testing them in the market over and over again until they become part of your automatic operating system. Think about the casino. I want you to really think about this analogy because it is one of the most clarifying I know. The casino never worries about a single hand of blackjack, not one. They don't celebrate when a player wins a big pot. They don't go into crisis mode when a player wins 3 hands in a row. They don't change their rules because someone at the roulette table had a lucky night. They operate with complete, imperturbable confidence in one thing and one thing only: their edge. They know with mathematical certainty that over a large enough sample of games, the house wins. And so every single decision they make is in service of that long-term truth, not in reaction to any single short-term event. That is what consistent trading looks like. You are trying to be the casino. You have an edge, a strategy that, over a large sample of trades, produces a positive expectation. And your entire job is to execute that edge patiently and consistently over enough trades that the edge can express itself. Every time you deviate from your process because you feel scared or greedy or desperate or excited, you are behaving like the gambler, not the casino. You are making decisions based on the emotional weight of individual outcomes rather than the mathematical reality of your edge over time. The paradox of this second truth is this: to trade better in the short term, you have to stop caring about short-term results. The moment you become more attached to the outcome of today's trade than to the quality of your process over the next 100 trades, you have already left the state of mind that produces consistency. You have to learn to measure your success not by whether you made money today, but by whether you followed your process today. That is a profound shift. And for most traders, it is the shift that makes everything else possible. The third truth is perhaps the most important one for small account traders specifically, and it is this: your brain is trying to protect you, and it is destroying your trading. I want to say that again because I want it to sink in. Your brain is not malfunctioning when you hold a losing trade too long. It is not malfunctioning when you cut a winner early. It is not malfunctioning when you freeze at the entry and miss the setup, or when you jump in impulsively without waiting for confirmation. Your brain is doing exactly what it was designed to do. It is trying to protect you from pain. And in every other area of your life, that protective mechanism serves you beautifully. In trading, it is sabotage. Here is the neurological reality. Humans feel the pain of a loss approximately twice as intensely as they feel the pleasure of an equivalent gain. This is not a character flaw. It is not weakness. It is evolutionary hardware, forged over hundreds of thousands of years of human experience in environments where losses of food, of shelter, of safety could be catastrophic. The brain learned over millennia to weight negative outcomes more heavily than positive ones because in a world of physical survival, that asymmetry kept you alive. But in the market, that asymmetry kills you. Slowly, quietly, consistently, it kills you. Loss aversion makes you close winning trades too early because your brain is terrified of watching a winner turn into a loser. It makes you hold losing trades too long because in your brain's framework, a loss is not real until you close it. So it keeps telling you that there is still a chance, still a possibility of recovery, still a reason to wait. It makes you add to losing positions because your brain processes the open loss as a wound that needs to be healed, and adding to the position feels like taking action, doing something to fix the problem. And with a small account, every single one of these tendencies is amplified because the stakes are proportionally higher. A $200 loss on a $500 account represents 40% of your capital. And your nervous system processes that loss at a visceral, almost physical level. It doesn't receive it as a data point, it receives it as a crisis. So what do? You cannot simply decide to not feel things. You cannot meditate your way out of neuroscience. The solution, the only solution that actually works, is what I call pre-decision. Pre-decision means making all of the critical choices before the trade begins, not during it. Before you enter, you decide your stop. You decide your target. You decide your maximum position size. You decide in advance that if the trade hits your stop, you will close it, no exceptions, no renegotiations, no second opinions. You commit to these decisions when your rational mind is fully in control before the trade is open, before the P&L is moving, before your nervous system has been activated. Because here is the reality. The moment you have money at risk in a moving market, your primitive brain begins to take over. The prefrontal cortex, the part of your brain responsible for rational decision-making, impulse control, and long-term thinking, actually loses influence over your behavior as emotional arousal increases. The limbic system, ancient, reactive, emotionally driven gains influence, and decisions made from the limbic system in a trading context are almost always wrong. Predecision is the technology that keeps your rational mind in charge when your emotional brain wants to take over. And it is the single most powerful behavioral tool available to a small account trader who does not yet have the deep, automatic beliefs of a professional. The fourth truth, and this one I want you to carry with you long after this video is over, is this. Your small account is not a prison. It is a school. I mean that with complete sincerity. The small account is not a waiting room where you sit until you accumulate enough money to start your real trading career. It is the curriculum. It is the place where you develop, at the ground level, the psychological foundation that every consistently profitable trader is built on. Think about what the market is actually testing you on with a small account. It is not testing your ability to read a chart. It is not testing your knowledge of technical analysis or fundamental analysis or market structure. It is testing your character. It is testing how you handle uncertainty, how you respond when you are wrong, whether you can keep a promise to yourself when no one is watching, whether you can feel the fear of loss and act according to your plan anyway, whether you can resist the seductive pull of revenge trading after a bad loss, whether you can take a setup that your system calls for even when it feels terrifying. These are not trading skills. These are the deepest human skills. And they are worth more in trading and in life than any technical edge you could ever develop. Here is what I have observed over decades of working with traders. The ones who develop these skills with a small account, who truly use the small account as a laboratory for self-understanding rather than a vehicle for quick profits, these are the traders who eventually build sustainable, lasting results. Not because the universe rewards patience, but because the skills they develop at the small account level scale perfectly. The self-awareness, the discipline, the emotional regulation, the acceptance of uncertainty, all of it carries forward into larger accounts, into more complex strategies, into longer time horizons. The traders who skip this step, who blow up a small account and immediately fund a larger one without understanding why the first one failed, are simply buying themselves a more expensive version of the same lesson. The lesson will come. It always comes. The only question is how much it will cost you. Use the small account. Respect the small account. Not as a limitation to be transcended as quickly as possible, but as an opportunity to do the foundational work that most traders are too impatient, too proud, or too afraid to do. The paradox of the fourth truth is beautiful, and I want you to sit with it. The traders most frustrated by their small account are often the closest to their breakthrough, because frustration, when it is honest, is a signal that something needs to change. And the traders who are willing to direct that frustration inward to ask, what in me is creating this result? Rather than, what is wrong with the market? These are the traders who are standing on the edge of transformation. You might be one of them right now, today. So let's make this practical, because everything I've said so far is worth nothing if it stays abstract. Understanding without application is just philosophy. And while I love philosophy, what we're here to do is to actually change the way you trade, starting with your very next session. So I'm going to give you 4 practices. They are simple, they are not complicated, they do not require a subscription, a course, or any additional technology. What they require is honesty and repetition. That's it. The first practice is what I call the pre-trade declaration, and it is exactly what it sounds like. Before you place any trade at all, you write down 3 things. Physically write them, not type them. Write them with a pen on paper, because the physical act of writing creates a different kind of cognitive commitment than typing. You write, 1, the specific reason you are entering this trade, not it looks good or I have a feeling. A specific, observable, rule-based reason. 2, the exact price at which you are wrong, the stop level, the line in the sand, the point at which you will close the trade and accept the outcome. And 3, and this is the one that most people want to skip, so don't skip it. You write a single sentence in which you explicitly accept that this trade may lose. Not, this trade will win. Not even, I believe this trade has a good chance. You write, I accept that this trade may lose, and if it does, I will not change my process. This practice sounds almost too simple, and that simplicity is exactly what makes it powerful. Because what it is doing at the neurological level is training your prefrontal cortex to stay engaged. It is creating a pre-decision record that your rational mind can return to when your emotional brain starts pushing back during the trade. It is the beginning of building the habit of thinking before feeling rather than feeling before thinking. Do this for 30 trading sessions. Every single trade, no exceptions. And then look at what changes. The second practice is this: trade the smallest size that still feels real. I want to be precise here because I have seen people misapply this advice. The goal is not to trade so small that you feel nothing. Feeling nothing is not useful. If there is no emotional engagement whatsoever, you are not actually training your nervous system for the real conditions of trading. You are just playing a video game. The goal is to find the position size at which you genuinely feel the trade. You are aware that real money is at risk. Your body registers the fact, but the emotional activation is not so intense that it disrupts your thinking. That is your psychological training ground. For some people, that might be one micro lot in Forex. For some people, it might be a single share of a stock. For some people, it might be the smallest possible futures contract. The number is different for everyone. What matters is the feeling engaged but not overwhelmed, present but not panicked. That is the state in which real psychological development happens. Every session you spend trading at that level, following your process, making pre-decided decisions, accepting outcomes, that is a deposit into what I think of as your consistency account. And just like a financial account that compounds over time, the psychological account compounds slowly at first and then faster than you can imagine. The third practice is the 20-trade reframe. And this one is about changing the fundamental unit of measurement you use to evaluate your performance. Right now, if you're like most small account traders, you evaluate your performance trade by trade. This trade won, so I feel good. This trade lost, so I feel bad. This session was profitable, so I'm a good trader. This session was negative, so I'm a failure. And that evaluation framework, that habit of measuring yourself by individual outcomes, is what keeps you in the emotional cycle I described earlier. It is what keeps you making decisions based on how you feel, rather than what your process requires. The 20-trade reframe asks you to do one thing. Stop thinking about your current trade as a trade and start thinking about it as trade number 7 of the next 20, or trade number 3, or trade number 14. Whatever it is a sample member in a statistical series, not a standalone event. It carries no special weight. It is not the trade that will prove or disprove your viability as a trader. It is one data point in a distribution of outcomes that, over 20 repetitions, will tell you something genuinely meaningful. Keep a simple log. After every 20 trades, sit down with the data, not to judge yourself, not to celebrate or despair, but to look with honest, curious eyes at what your edge is actually doing in real market conditions. To understand your psychological patterns at a scale that actually has statistical meaning, to separate the signal from the noise. This practice, more than almost anything else, is what begins to shift the way your brain processes individual trade outcomes. Because when your operating unit is 20 trades rather than 1, the emotional weight of any single loss drops dramatically. And when the emotional weight drops, your decision-making improves. And when your decision-making improves, your results improve. It is a virtuous cycle, and it starts with a simple change in the mental frame you bring to each trade. The fourth practice is the simplest of all, and in some ways the most profound. At the end of every trading session, before you close your platform and go live your life, you ask yourself one question. Not, did I make money today? Not, was I right? Not, did the market cooperate? You ask, did I follow my process? That's it. That is the entire question. If the answer is yes, if you identified your setups according to your rules, if you entered for the specific reasons you said you would, if you placed your stop where your process dictated, if you did not move that stop when the trade went against you, if you did not close winners early out of fear, if you did not add to losing positions out of hope, then that session was a success. Regardless of the P and L, whether you made money or lost money, you won the only game that actually matters in the long run, the game of consistent process execution. And if the answer is no, if you deviated from your process, if you let your emotions make a decision that your rules should have made, then that session is still valuable, not as a failure, but as information. Where did it break down? What was the emotional trigger? What belief activated that caused you to override your own plan? Write it down, be honest with yourself, and bring that self-knowledge to the next session. This is how traders grow, not through a sudden, dramatic breakthrough where everything clicks at once, not through finding the perfect strategy or the perfect market or the perfect conditions. They grow through this quiet, daily, unglamorous process of honest self-examination, consistent process execution, and the gradual, steady accumulation of proof to themselves that they can do this. You can do this. Let me come back to where we started. You have a small account, and I know that somewhere beneath the analytical questions about strategy and risk management and market structure, there is something more personal, something quieter, a voice that says maybe you've been hearing it for a while, that maybe the small account is telling you something, that maybe the struggle means something about who you are and what you're capable of. I want to speak directly to that voice right now, to that fear, to that doubt. It is wrong. The size of your account is a starting point. It is a set of coordinates, not a destiny. It carries no information whatsoever about your intelligence, your creativity, your resilience, your potential, or your ultimate trajectory as a trader. What it does carry, what every small account carries, is an invitation to do the work that most traders refuse to do, to go inward instead of outward, to ask harder questions, to develop something more valuable than a strategy, a relationship with yourself that can function under pressure, in the face of uncertainty, with real consequences on the line. Here is what I know. After decades of working with traders at every level, the traders who eventually achieve what every retail trader is chasing: consistent profitability, psychological freedom, the ability to sit in front of the market without fear, they all have one thing in common. Not a better system, not a bigger account, not superior intelligence. They have done the interior work. They have looked honestly at what was happening inside them during trades. They have identified the beliefs that were costing them money. They have replaced those beliefs through practice and repetition and honest self-examination with beliefs that actually serve them in the probabilistic environment of the market. And every single one of them, without exception, did a large part of that work with a small account. The small account is not where trading careers go to die. For the traders who use it correctly, who treat it as the school that it is, the small account is where trading careers are actually born. So let me leave you with 3 things that I want you to carry forward from today. First, the market is impersonal. Your results are a function of probabilities playing out over time, not judgments about your worth as a person. Every attempt to make trading personal, to read meaning into outcomes, to feel targeted by the market, to let a red trade color your identity, will cost you money and peace of mind. The market does not know you exist. That is not a cold fact. That is freedom. Second, your brain is not broken. It is running the wrong software for this specific environment. Evolution built you for a world of physical danger, certain rewards, and clear threats. Trading requires something completely different: comfort with uncertainty, emotional equanimity in the face of loss, and the ability to think probabilistically rather than personally. That operating system does not come installed. It is built deliberately through practice, one pre-decided trade at a time. And the building can start today. Third, your small account is not a prison. It is a school. And the curriculum, the real curriculum, is not technical analysis. It is self-knowledge. It is the